We're joined now by a long-time observer of the ETF market, Mike Philbrick, CEO of Resolve Asset Management. Mike, it's great to see you. We have been hearing this week about the enormous inflows into the ETF market in both the US and Canada. The Wall Street Journal has a headline today: ETFs are eating the world. They're so popular, eclipsing mutual funds. Certainly in terms of growth. In fact, money has been coming out of mutual funds. What has interested you about these flows, though?
Well, it's been interesting. 2025 was certainly the year of momentum meeting Main Street for the ETF world. Low fees, endless choices, 125 billion in inflows, 1.2 trillion in trading in Canada. It's been a blockbuster year. And I think this year has also been a year of innovation and rotation.
Right. What in particular have we seen in terms of rotation?
What was interesting, right? So if we take a trip in the time capsule back to April of 2025, we saw the tariff tantrums really kind of cause a lot of market consternation. And during that period, rather than seeing a rotation from stocks into, let's say, safe assets like bonds, what we saw was rather a rotation from, the U.S. market dominance to international stocks. The Canadian market, for example, outpaced the U.S. market. We saw moves into precious metals. We saw continued development in the digital asset space. So we saw that broadening of the market rally from technology and broadening out into things that are going to be needed to provide that growth in the AI space.
We've seen so many innovations, though, here. Option income, leverage inverse, crypto asset. But we've also seen what you say is strong demand for simple asset allocation ETFs as a one-ticket solution. Is that, for example, ETFs that would invest in both stocks and bonds?
It's actually across the board. Yeah, we saw that one factor was pretty interesting in 2025, that investors were looking for sort of that single ticket option and in more of the core drawer rather than the explore drawer. A lot of stuff was fun and flashy, that you talked about some of the levered covered writing ETFs. Mm-hmm. But this fell in the category of, hey, just give me one ticket. Diversification across whether it was asset classes, stocks, bonds, maybe some gold, maybe some Bitcoin, also across factors. One of the ETFs I'm bringing everyone's attention to today is the FEQT, which is the Fidelity Global ETF, which this one is really interesting because it's across these areas like Canadian stocks, sure, you have that. And then you have the sort of momentum, value, and quality plays within that, as well as international, in that U.S. play and international plays as well. And also with about a 3% allocation to Bitcoin. So here you have a wonderful equity replacement. You've got all the factors covered. You've got the geographical regions covered. You've got a small slice of digital in there. And so you can kind of forget it, set it and forget it. And that's been attractive for clients. And that's nice to see because that's a really great product for the long term for investors.
That's interesting. One ticket global equity fund from Fidelity. Another one has caught your eye, and this is PFAA, the Picton Mahoney Fortified Alternative Fund in Canada. What does this one hold?
Well, this one is a liquid alternatives multi-strat or multi-strategy fund. So it's got things like merger arb in it. It's got long short equity portfolios in it. And so it's got a portfolio of about 5 to 6 different alternative strategies. And these alternative strategies they move differently than the market. So what this can do is it adds some stability to the portfolio. So if you're someone that's looking at 2026 and saying, geez, my bonds aren't what they used to be, and I am worried about a little bit of equity risk, this is something that can add some durability to the portfolio and doesn't necessarily require equity beta or an equity bull market to actually provide some returns. That also provides the benefit of a nice place to rebalance to and from. So when your equities run up a lot, you rebalance back to a weight, adding to a fund like Picton Mahoney. If equities pull back, then you actually have a place to harvest some capital from to buy those equities in a dip when you've got a fund like the Picton Mahoney fund in your portfolio.
The Wall Street Journal is a little skeptical, though, about some of these more exotic funds. It says that some of them have unbelievable yields. It says that one that sells covered calls on Tesla touts, and I'm just quoting from the Journal here, a 46% distribution rate, in quotes. However, since 2022, investors have just made 62% in total. So some of these structures don't work out that well.
Correct. And, I'm going to call it yield porn. To some degree, investors can get mesmerized by those lead yield numbers. Mm-hmm. And you always have to look at what's the total return for the year. If the yield was supposed to be 42% and the total return of the underlying product was 12%, your return was 12%. And the yield is a distraction, and it's probably not helping you from a portfolio perspective. We also saw some paying weekly instead of quarterly. And so some of that can be distracting and can be deleterious to investor outcomes. So you have to be very careful. There's a lot to unpack in that. We don't have time today, but one of the rules of thumb is if you've got a 42% yield, but it's only earned 16%, you receive 30% of your capital back.
Sorry, give us that last number again, Mike, please.
Well, if the yield was 42%, let's say, and you made 12% on the year, really you received 30% of your own capital back. It wasn't that you actually made those money. So you want to look at that yield with respect to the total return of the ETF, the underlying ETF, to give you a sense. That's just one quick and dirty way to take a look at it and see if you're actually receiving the yield or you're just receiving your own capital back.
Right. And it is interesting. ETFs exceeding, obviously, by quite a margin, the number of listed stocks now, is certainly in the US market, and I'm sure in Canada as well.
Yeah, absolutely. And that's actually not new. I mean, back in the 90s, when there was a proliferation of mutual funds, the same thing occurred. The number of mutual funds outnumbered the number of stocks. And that's, fundamentally going to be true if you've got a constituent to 2,000 equities and you're going to build products off of that. You could build infinite number of products. From that, value tilt to quality tilt to covered right, levered. The proliferation of choice is huge, and investors have to be careful because some of that is a distraction. And what's your daily driver? What's going to do most of the work versus what's a shiny bauble in the portfolio? And that's that core and explore approach. Just make sure you're sticking with more core, lower fee stuff and adding the higher priced things around the periphery.
Mike, what do you think would be the next big thing in ETFs, though? Because they are, there's no doubt, cannibalizing the mutual fund industry or eating it up.
Yeah, I mean, it's hard to dispute the investors' yearning for yield. So I think, the yield plays are still going to have a particular role and attraction for clients. Some things that we're seeing on the portable alpha side, return stacking is something that we do. But this is taking the beta that love and trust, stock, bonds, and so on, and adding the diversifier on top. And so that's been popular, and we've seen that across the board growing nicely. So I think we'll still see more of the income side. I think those products are going to get better, too. I think that investors are wising up. And so are providers. So you're seeing better options for those covered writing strategies, for those levered strategies to give clients better outcomes. So I think we will see improvements in the products we have. As for what's new, I think that portable alpha play is interesting. And I think we're going to see more of those one-ticket items, one-stop ticket items where it's a fully baked product you can own.
Mike, thank you very much indeed. Mike,
always a pleasure, Andy.
Mike Philbrick, CEO of Resolve Asset Management.